All right. Shelby, should we start or should we introduce, go around the room, introduce ourselves and start in 2 minutes?
I say let's go around the room, introduce ourselves, and start in 2 minutes. I think that's a good idea. So, hey everyone, thanks for joining.
All right. Thank you, Shelby, for putting this together. Who wants to go first? Either you want to start? Can't hear you.
I was muted because I didn't get permission from the host to unmute.
Oh,
Sorry about that. Good morning, everybody. I'm Vito Mazza. I work with Kinnem, and I love coming to these events because it gives me good information for my clients who I'm helping to collect their accounts receivables. So if I could be of any service to you all, feel free. Thank you.
thanks. Thanks for coming.
Yeah.
I'm going across my screen. Brian. Ken, you're next.
Sure. Brian Newman from Absolute Authorizations. We are a ancillary company that provides services for nursing homes.
All right. Ken and then Barry.
Ken Amato with Imperial Advisory. I'm FPA strategist at Imperial.
And our newest partner.
New partner.
Congratulations.
Thank you.
Barry and then Steve. We can't hear you, Barry. Barry, are you on mute?
I'm off mute. I've been a senior financial executive for more than 50 years. I find that working with Imperial is both challenging for me and sometimes a benefit to the client, which is what we really want to do.
Thanks, Barry. Steve and then Jim.
Morning, guys. Any ladies that are on. Steve Rupolo, I'm a fractional CFO for Imperial. Prior to joining Imperial, I was CFO for a technology company for 33 years.
Thanks, Steve. Jim and then Mark.
Good morning, everybody. My name is Jim Altieri. I'm a fractional CFO and consultant working with Imperial for the last couple of years. I've got about 35 years in the industry. I've worked at companies like Coach and Timberland, Toomey, and a bunch of private equity businesses as well. I'm all about sustainable business solutions. So I'm an accountant, but I'm into process big time and system implementations.
Thanks, Jim. Mark and then
Mark Solowski, Imperial
Frank.
CFO, been a senior financial person for 35 years, mostly in the healthcare business, both pharmaceuticals and the device side. So kind of my specialty. Did a little bit of distribution as well.
Thank you, Mark. Shelby, I think is going to be on a call. So Frank and then Bob.
Hey everyone, Frank Brigazzi with CIBC Commercial Banking, located in New York, focused on middle market clients throughout the Northeast.
Thanks, Frank. Bob and then Yehuda.
Hey, it's Bob Hope, the managing partner at an independent digital business and IT consulting shop called Disruptive Innovations. We focus on cybersecurity, customer experience optimization, data, networking, cloud communications. How you doing, Gershon? Good to see you again.
Good. Good to see you, Bob. Thanks for joining. Adam and then Esther.
Hey, morning, everybody. Adam Breyer with CBiz Insurance out of the New York metropolitan region. Look forward to learning. I have to pop up a little bit early, but thank you so much.
Sure. Esther? and then Howard.
I'm trying to think of how I got onto this group. Nice to meet you all. My name's Esther. I'm an investor and a capital connector. I raise money and I raise kids for commercial real estate.
Welcome, Esther. Thank you. Howard, and then I think we're going to get started. Who's the newest Imperial CFO? Is that Ira? Yes, we'll find out. Howard.
Hi,
I
nice
think that's
to meet you.
Andrew.
Thanks for having me, Gershon. I run a firm called Morward Funding. We arrange financing for what I would call unbankable businesses. So when a bank is not an optimal solution, or perhaps not even a solution at all, typically these financings are backed by working cap, by collateral such as receivables, inventory, equipment. But we also work with lenders that have a sort of non-traditional view of collateral too. So, thank you.
Welcome. Thank you. Andrew from Imperial. Why don't you go, and then we will get started.
I can't. Oh, wait, I think I can.
We can hear you, even if we can't see you. We'd love to see you too, but.
Yeah, I appreciate that. What would you like? You'd like me to present myself? Is that what you're asking?
Yeah, just say hello, say hi, I'm Andrew. I love Imperial. I love our.
Yeah, I'm Andrew D. Francesco, former CFO of a multi-billion-dollar company and 18 years in public accounting.
Welcome, Andrew. All right. Shelby, any update? All right. I am Gershon Margolis. I'm the founder of Imperial Advisory. I think we hit pretty much everyone here. We had one more speaker. He is not here. Shelby's trying to get in touch with him. Something must have come up. But without further ado, let's get started. And hopefully he will come. I'm sure he'll have a lot to add. But welcome, everyone. Thank you all for joining us today. It's good to be here with you. I am Gershon Margolis. I am the founder of Imperial Advisory. We are a team of fractional CFOs. I'll give a little intro to the firm, and then we'll segue into the webinar, and we'll start by introducing the speakers, or letting the speakers really introduce themselves, and then we will get to the program, to the questions, and hearing their take on the recession or potential recession and what we can all do about that. So now for the intro to Imperial. In large organizations, the CFO is often one of the CEO's most trusted advisors. For companies not at the size where they need a full-time CFO, using a fractional CFO gives them the same sort of strategic guidance and benefits for as much or as little as they need. We pick up where the accounting department leaves off, and sometimes we'll end up serving as a second set of hands for an existing CFO. Those are typically much larger companies, several hundred million or more. Several of our CFOs have also held other C-suite positions, such as CEO or COO, and most of our CFOs have over 30 years of experience. Besides for being the day-to-day CFO, we get involved in mergers and acquisition, other fundraising advisory, and a variety of things throughout the company. Strategy is a big part of what we do, and so dealing with potential recessions and approaching how to deal with that is certainly something that is in our wheelhouse, and that's why we're here to discuss that. I'm very pleased to be here today with you all. Pleased to have Jay Biss, who is a banker at Valley Bank, and Steve Rupolo, who's one of our amazing CFOs, and hopefully we will have another speaker, and we'll introduce him when he gets here. Anyway, I'm going to start with asking Steve to introduce himself, and then after that, I'll ask Jay, and then we'll get started. Steve.
Sure. Thanks, Gershon. So as I mentioned before, I'm currently a CFO with Imperial. Most of my career was spent at a company called Small Source Technologies. We were a technology company that was in the event space and was there 33 years and saw, two, let's say two run-of-the-mill recessions. Obviously, the
Terrible.
turn of the century. Can you not hear
You're an
me?
embarrassment.
Barry, did you have something to add?
I don't think that was to you.
Okay, so saw two recessions, the dot-com bust in 2000, and then obviously the Great Recession in 2008, 2009. Not so sure I would count COVID as a recession other than just really a black swan event. So I've dealt with recessions in the past, how to deal with it, and so I guess that's what we're going to speak about today.
Sounds good, Steve. Looking forward to hearing your perspective here. And now, Jay, please introduce yourself. I'm very excited to have Jay here as well because Jay is part of a very interesting sector this month, and this sector that deals with recessions and deals with clients who are dealing with them. So looking forward. So please introduce yourself, Jay.
Yeah, good morning. Thanks, Gershon, for the ability to speak here today to everybody and answer questions. I'm Jay Biss. I'm a business banker at Valley Bank. Been here for a year and a half. Previous to that, I was at 9 years at Citibank. I deal with small businesses, so businesses $20 million in revenue or below. I help them with lines of credit, with loans, SBA, investment real estate, a lot of different things. And I was a small business owner myself. This is sort of what inspired me to get into what I do and why I focus on small business. I was a small business owner, didn't necessarily have a great connection or relationship with the bank. So I understand the value of having that relationship and what you can do to help leverage the bank to benefit your business. The business that I started was back in 2001. So yes, there was a recession at that point. And so I can speak to a little bit about that, but I've been banking for 10 years. So I've seen a lot of different companies and see what they do and how they adjust during that period of time. Looking forward to answering any questions as well.
All righty. So thank you. Thank you, Steve. Thank you, Jay. Let's get started. All right. So Steve, we're going to start with you. What are the key indicators of a recession and how can businesses prepare for economic downturns?
So obviously, we know that how the government defines a recession is two consecutive quarters of negative GDP growth, and that's good from a government standard point of view. But from a company point of view, recessions affect companies differently, and each company sees recessions that may not even be the time that the government says we're in a recession. I know when 2008 hit, the government said in December 2017 that we were officially in a recession. At our company, we didn't see it until 8 months later, we started seeing a downturn. So, and some companies actually do well in a recession. If you're in like a discount retailer and a recession hits, people are now going to look to cut costs and they're going to try to spend less shopping. So certain industries will do well in a recession, while certain industries will be hit more severely in a recession. One of the things we always looked at, a recession really hits your revenue. So when you start seeing your revenue tail off, you could say, wow, we're starting to see a recession. But there are indicators that even before revenue starts to trail off. One of the things we always looked at, we had a dashboard, backlog reports, and we always looked at what is being booked in the future. So we had a report called the Future Book Business Report, which we'd monitor, which looked at our bookings 3 to 6 months out. So when we saw in 2008, 2009, we saw our future revenue that's booked start to go down versus prior years. So that was the biggest indicator for us is, are our clients booking way in advance? So if the clients are starting to see a recession, they're going to pull back on their orders. So that was the best indicator for us, future book business. How is it trending year over year and how compared to what it's been? So that's what we use. If we saw revenue in the future starting to tail off, we said, we got to start taking steps now because we're going to start seeing decreased revenue in the future.
Thanks, Steve.
Jay, you want to add anything to that?
Yeah, I mean, I think that this is a different recession, if you want to call it that, than others. You know, a lot of it is based on the higher demand, really. People have more money to spend on things. You know, we also have supply chain issues. So there's more money in the hands of a typical American now than you've had in the past because we had handouts during COVID. We had PPP for smaller businesses. So there's more money in the supply, and then there's more ability to spend. And so the demand needs to catch up essentially. And so then on top of that, you take a look at, you know, what's going on with US-China relations and what's happening there. So supply chain, more money in the economy, the inflation numbers go up. And so that affects, you know, what we're calling a sort of a recession to some degree. But the bigger businesses that are able to handle sort of change with regards to work from home, you know, we have Zoom now, right? We have technology that's enabled us to sort of adjust on the fly to these things. And those businesses that had to adjust quickly and weren't able to were the worst hit, essentially. When COVID happened, those businesses that didn't necessarily have that all set up, they weren't as resilient. They didn't have, let's say, money in place to be able to handle the stress. Those are the ones that really hurt the most. So yeah, so key indicators are the typical, like what Steve was saying. But I think for, you know, smaller businesses, they're looking at their costs going up, you know, and where is that coming from? Talking to your vendors and getting an understanding of where that's coming from on their side. That sort of gives you an idea about what's going to be happening in the next couple of months.
Got it. Interesting. So it sounds like the common theme is looking ahead, understanding what those indicators are, what's going to be driving the success of your business 6 months out. It's not necessarily just about revenue today or about expenses today. If they change the price today, then next year's gross profit is going to look very different.
Yeah.
Price of the inputs.
Something else too, just, you know, is reaching out to your vendors and your clients as well to see what they're going through, what they are struggling with. As a CEO, you really need to be in communication with those parts of your business. You want to make sure that you understand where your vendors are coming from and why their prices are going up. So keep that open line of communication so that when something does come up for them, they feel like they can pick up the phone and call you and tell you what's going on. And the same thing with your clients as well. And then that way also, if you need to raise prices, at least the clients understand why you're raising that price.
Got it. Thank you, Jay. All right, let's see. Next question, we'll start with Jay. Oh, you already covered it. How this recession is different than other recessions. All right.
Let me add one thing on that, how this recession is different. And it's very interesting. So in prior recessions, you have, usually when we hit a recession, we have unemployment going up. Workers are available, there's people being laid off. One of the challenges in this recession for companies is that there is still a huge shortage of workers. So I have a client who's worried about the recession. He's worried about letting some employees go because he's worried about getting them back. So what's a little different now is you got to be a little bit more creative with your workforce, because you start reducing workforce during a recession. When then things pick up, people are worried about how do I hire these people back, because, you know, people that are let go, it's easier to find jobs. So that's one thing that's really different in this recession is a labor point of view. And companies are worried about, right now they can't find enough employees, worried about a recession. I got to cut costs. Do I let people go? And then what do I do when I have to try to find people back? So that's one thing that's certainly different about this recession than in the past.
Got it. And there's actually something that we brought up with one of the clients you were working on, Steve, that, yeah, you go take care of that, where there's apparently a government program that we learned about during COVID that you can kind of lay people off part-time and the government will pay partial unemployment and you'll keep them employed for part of the time. And that was something that you actually mentioned to one of our clients in the Midwest.
Correct.
I don't know if that's the one you were just talking about. All
There
right.
are government programs that when you do have to, if you've got to reduce your workforce, the government will, there are some programs that they'll pick up some of that cost of your layoffs.
Got it. All right. Next question for Steve. What are some steps that a business can take to stay financially sound? Remember how this goes, Jay? So that Jay doesn't come after them.
So during the last recession in 08 and 09, our earnings took a hit, but we were able to do some things that maybe mitigated our cash flow. So we were able to do things like cut our CapEx spending, increase our product sales, to kind of offset what we were losing in earnings and pick up in cash flow. So the banks, we told the banks, listen, our earnings are going to take a hit, but our cash flow will still be good. So we did that. In terms of labor, we did furloughs. Instead of laying people off, we told people we'll furlough you. You're going to see a little less in income, obviously, but you're going to have time off. So we'd give them, 1 day off a week for our hourly employees. Some of the employees like that. Said, okay, I understand we're going through a tough time, but at least, you're not cutting my pay. You're going to give me some time off and I'll, use that time. So there are ways that business could get creative to try to reduce their costs during a slowdown and try to keep their workforce intact and able to reduce costs.
Got it. But that's a good idea in terms of both communication with your bank, but also another type of creative idea of what a business can do to help themselves. It's not just for the bank, it's for them. Get creative in how you deal, whether it's with people or with the deals you take on, and focus on what it is that's important to your business right then, whether it's cash flow or profit or whatever in the short term. Interesting. Jay, you have anything to add?
Yeah, I'll add to that. Yeah, that cash flow is really important. In fact, Steve mentioned, I just wanted to highlight that piece of it, is that ultimately that was what they worked on with the bank, because that's pretty much the #1 metric that they look for. There's always a debt service coverage ratio that the bank will look for. And we want to make sure that for every dollar we basically lend you, you have $1.25 in cash flow, EBITDA, basically. So, all the other things, receivables, they can go high, they can go low. We understand that. That's more of a collateral thing. But when it comes to cash flow, collecting the actual dollars and putting them in the account, those things are the most important things. So, banks are going to be looking at that. So when you're dealing with a bank and you're negotiating with them, and if things are getting a little bit tight, you want to at least make sure that you got that squared away in some way, shape, or form.
Got it. Thank you, Jay. We have a question in from the audience. It came to me. How do you know which businesses take hits and which increase during a recession? Is there a way to know that? So the way I understand the question, it's who's going to benefit from a recession and who's going to benefit from a recession and who's going to hurt? And how does a business make themselves the type of business that will benefit?
Well, I think you try to find lines of business that are recession. It's not easy for every company to do that, but if you could find, diversify a business, that some line of your business would do better in a recession. I know with COVID, we were, I was CFO of Smart Source. We were in the live event business because we did provide technology at live events. So the revenue got crushed because all live events stopped. But what we did is we kind of pivoted and we said, okay, live events have stopped, but now that everybody's going to be doing work from home. So we had a lot of inventory. So we were telling our clients, we will give your employees laptops, because we had tons of laptops, and they could use them to work from home. So we kind of didn't obviously make up all the revenue we lost, but we were able to say, okay, now work at home is a big thing. What can we do? We give them laptops, we'll set up printers in their home, we'll set up, make sure they got cameras on their desktops at home, and they could do Zoom meetings. So there's ways to try to pivot and look, well, what's, during the recession, what is now working, and then try to pivot to those areas.
Yeah, and I'll add to that too. And I think it really depends on the recession. Depends on what the economic indicators are. So, for example, in 2001, we're talking about the dot-com bubble. At that point, I was in print graphic design. But what we did to pivot was to go into online. So we went for websites, we went for evites. We did less in terms of print, and that's just the way it was. And at one point, we thought print was going to go away. It didn't. But at the same time, we just knew that we needed to pivot in that direction. And we did. We had the skill set to be able to do that. And we talked about that with our clients more, knowing that's where the demand was coming from. In this past COVID situation, obviously, Steve talked about working from home. It was sort of like a stake in the ground, essentially, where everything had to stop and everybody had to do this thing another way. So if you were coming to the office, that was it. It was going to stop as of March, 13th, 2020, and that was it. You were working from home. So if you didn't have a plan in place already, you needed to pivot quickly to make sure that you had something there. And thank God the technology allowed us to do that. Zoom boosted the ability for us to do business. And I think sometimes the economic indicators aren't sure. No one's sure how to deal with that. I think the Fed struggles to deal with what exactly is going on. Because I think there is a lot of productivity indicators. A lot of businesses did well and adjusted and had the technology in place. So it wasn't necessarily a bust for those businesses. So yeah, I think it really depends on what type of business that you're in, and knowing what the solutions are. And that's why it helps to have sort of a fractional CFO type who can sort of, guide you through that.
Thanks, Jay.
Yeah.
I want to just jump in for a second because I have a couple of examples, a couple of things to mention, which are two things. One is that they both relate to COVID, but I think it's more about the idea and less about COVID. One is that there was a company who was different than Steve, but they were also in the live event space. There were a whole category of companies. There were catering businesses. They catered weddings, they catered corporate events, whatever it was, right? When live events shut down, catering businesses lost their initial, their primary source of income. But there was still opportunity. And I think the question is about uncovering the opportunity. So in my neighborhood, probably in other neighborhoods, some of those companies who had relationships with food suppliers and who had the ability to distribute food and to process food, those companies pivoted into giving out food, right? The government was saying anyone who had kids under the age of 18 or something like that was eligible to get, there was food. So I remember hearing about this, and I believe that there were companies, in my neighborhood, I believe that it was a catering company that was their primary business, and they were in some type of food service which no longer existed during COVID. But they pivoted and said, okay, well, we'll supply food under these circumstances. And so, their business was shut down, but they found a way to do something else using the skills and know-how that they had. And again, another example, early on in COVID, there was a fellow I knew who was CEO of a process serving company. He would serve papers. And I guess the courts were closed, so there was no paper to serve, or whatever the situation was, his business was shut down. But what I said to him was, you have a whole team of people who are experts at delivering stuff. Find something that needs to be delivered and go deliver that. Said, everyone's nervous about going to the grocery store. Let your people deliver groceries instead of delivering paper. And if you deliver groceries, that's a service everybody wants right now. So this doesn't necessarily work with every business, but there are many situations where whatever, if you look at the business, look at the people, look at the actions that you're taking, look at the clients you're serving, there could be a different way to serve the same client or customer. There could be a different customer to serve doing the same type of actions that you already know how to do. There could be a different industry that needs what you need. And then, of course, there's just what we were discussing earlier about diversification, being in industries which are resilient. Some industries don't tend to go out of style. Like they say, garbage collecting is very recession resistant. People always have garbage. Anyway, Anything else? Or should we go on? Any questions from the audience?
Yeah, I have a question.
Okay.
Can you hear me, fellas?
Yes.
Yes, we
Yeah,
can.
I have a question for Jay, actually. Jay, under the circumstances of this particular morass we're in, the kind of recession we're in,
Sure.
you think the banks will be more willing or less willing to renegotiate covenants, financial covenants?
Less willing. Very specifically, when these things happen, the more sounder the bank, the more footing they feel like they have. So anybody who's coming to any bank right now that has fundamentals that are good are going to tighten the covenants. They're going to make it harder for you to do loans. It's already happening. Basically, after last week, we were told to make sure that certain things were as tight as possible, essentially. Think about it in terms of there's less supply now in terms of banks. So we're able to ask more of our clients, and at the same time, we're more in need, if that makes sense. The fundamental banks that are doing well, they're fundamentally sound, are going to ask for more.
I think it makes sense the higher up you are, but the closer you are to the ground, I don't think it makes sense. You take Steve's experience, for instance, where he was going to fall short in earnings, but he talked to the bank about, look, my cash flow is going to be good. Now, I don't know if Steve was violating a covenant or not, but there's more to look at than what you originally looked at before there was trouble.
True. Look, bottom line is the cash flow, like I mentioned, was probably the most important thing. At the end of the day, if a bank has a relationship with a client, they're going to want to keep that relationship. It's much harder to exit that person from the bank than to try to find somebody else to come on board. Both of those things are actually hard. We'd rather negotiate with the existing existing business to be able to keep that loan on the books. So yeah, if cash flow is there, ultimately that I would say is the biggest metric to look at. Banks don't want to exit somebody from their books, but it is they feel like they have an upper hand now.
Yeah, no, I understand.
Just being honest.
You're saying take a tighter approach to any new lending, but existing lending, try to keep the guy afloat without. I've had it. Yeah, I've had recently where we had a client that's looking to refinance an existing loan with us, and we've actually made some concessions. I was a little surprised, but yes, there is a difference between new to bank and existing loans.
Yeah, in that example, there was nothing we could do about the EBITDA covenant. We were going to miss it, and we couldn't create the EBITDA. But we went to the bank and said, listen, we're going to make all our other covenants, cash flow, our interest coverage, because we're generating actually a stronger cash flow than what we did when we were growing, buying a lot of equipment. Our CapEx was heavy. So the bank understood, they still hit us hard because we missed the covenant, but at least they worked with us and didn't, call the loan, or they continue to give us money for working capital and things like that.
Yeah, so the way they worked with you was waivers, I presume. They probably didn't change the covenants. They just waived the violation.
Yeah, generally that's what they would do.
Yeah. I had a question for Steve too. May I keep going?
Sure.
Okay. Steve, in your experience that you had when you were dealing with a real recession, did you have any leeway in your products at all? In other words, oftentimes in recessions, discretionary spending gets a serious hit, and buying quality goods as opposed to discounted goods. Did you have any leeway in the business you were in to change your product mix to help your bottom line?
We really didn't, because, not only, once you hit a recession, then all your competitors are in the same boat. And we wanted to avoid a race to the bottom in pricing, but it was difficult because our sales reps would say, hey, listen, this company's willing to do this rental for, 50% discount. So we would try to sell the service and, the dependability, but it's difficult, at some point you got to cut your prices to match competition because, everybody's in the same boat. They got excess capacity. They had a lot of product they wanted to move, and the demand was low. So it's difficult. I mean, you try to, not to sell on price, but to some degree during a recession, you're going to have to match your competitor, and you're going to have to lower your prices, take a lower margin. But if you got idle inventory, you got idle product that's just sitting around, you'll just take it at a lower price just to generate revenue.
I have one more question, Gershon, if it's okay with you.
Sure.
Yeah, it's directed to both of you fellas. You were talking about, both of you were explaining that this recession is different than others, and I agree with that. But one of the ways that I think it's different, and I think it'll show up in the consumer's appetite for spending, there's an awful lot of money out there in the hands of consumers that's unearned. That is to say that it's government benefits and so on. And I think people treat that kind of money different than they treat earned money. And I don't think there'll be as much of a slowdown in spending, even if there isn't growth. What do you guys think of that?
How long does that last?
How long does it last? Well, they keep giving it to them.
Are they still giving out free money?
Forget COVID extras. Yes, there's a lot more, let's say, being giving out right now than in the past couple of years than before. Government benefits, welfare and so on.
Yeah, I mean, I'll jump in. I mean, yeah, I agree with you. I think it's, as long as it goes on, that money is going to be spent, and so the prices are going to go up. That is driving a lot of the inflation. I think that's a part of it. So it's not like a typical recession, but I think there are other components to it as well. I think that's just 30% of the overall numbers. I mean, you've got supply chain issues, you've got the risk with China and those routes, basically the supply routes. So if that gets exacerbated, that could make it worse in some ways. So there are other elements to it as well. So yeah, I think what you're saying is true.
I think what's hitting consumers hard is the rise in interest rates, because if you talk, most homeowners have equity lines and they use that, and the cost has really, I mean, it's more than doubled. If you had an equity line, you're paying 3%, now you're paying 6-7%. That's really affecting the consumer spending. And I mean, true, they have a lot of money. A lot of people have money saved from COVID when they were actually just giving money out. But I think the government gravy train is somewhat really stopped after, COVID. And so I think we may still see this down the line. Interest rates are going to affect people and their spending.
Thanks, fellas.
Thanks for the question.
Thanks, Andrew. Anyone else want to hop in? Any other questions?
I got a quick question for Steve. You mentioned the future book business in terms of looking 6 months out, looking at what your receivables are going to look like. Is that the exact same process as forecasting, or is there other things that you took into considerations that this was different than a regular just forecasting situation?
Well, it's really not forecasting, because forecasting is only good as a forecaster, and it's really what do you actually see being booked. So in our business, people would book, like I said, we were in the live event business. People would book shows and conferences, and they'd book 6 months out, and that's really discretionary, because people don't have to go to trade show, they don't have to go to conferences. That's the thing that you could really cut, and it's like training. You could really cut that. So we saw less revenue being booked in the future. Actually saw that, hey, our revenue 6 months out is going to be a lot less than it was last year. So we actually saw signs of, actual, what's being booked as being less. The forecast, I don't, it's like economists. How much stock do you put in somebody's forecast?
But with the information you had, Steve, you could come up with a very accurate revenue.
No, we knew that revenue.
Because
We knew that our revenue was going to trail in the future. We saw that. We saw the trend coming. So we are actually able to take steps in advance to try to minimize our costs, going forward. Freeze on hiring, try to cut down some of our discretionary spending, whether it's marketing, travel, overtime, because we saw what was coming.
Right. Sure. Okay. Thank you.
Anyone else? Any other questions before we move on? Vito, I think you're muted, but.
Unmute yourself, Vito.
Sorry. Did I hear you just say we could cut things like blah, 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 training? Is that what you said, Steve?
Yeah, items that are discretionary. I mean, there was training budgets, travel budgets, going to see clients.
Okay. Well, I think that you're right on target with a lot of those things, but I've been in sales for a very long time now, and I've been through a few recessions. And here's the ironic thing, that when times are good, the sales force has results that is easier. They get more sales easier. Let's say it that way. When the recession comes, whether it's a real recession or a faux recession, selling gets harder. And the more training that the team has, the better they do. It's just an ironic twist on what you're talking about. But that's been my experience for a long time in sales and sales leadership.
So do I hear sales arguing with finance? That's news.
But I think it's a bigger, I think this is a bigger issue. It's everything that we spend money on when times are good is important. Not everything, but there are many things which you can cut. They're not discretionary in the long term, but it becomes a question of what is the right thing. When cash is tight, what is it that you postpone? And what is it that you don't do, even though you'll take a hit, but it's, something that we get involved in, whether it's in good times or bad times with clients, is talking about investing in marketing today. Some types of marketing have an ROI tomorrow. Some things take 6 months or a year to have an ROI. So it's understanding what money that you invest today, when does it come with an ROI? And if you have a cash flow problem today, sure, it will hurt you a year out with, let's say, marketing, for example, right? You're not beginning to build those relationships today, which take a year to develop, if that's the case. But if the other option is not being able to fulfill the business you have today, then, you have to weigh these things. And this is what, sales has input on that, and finance has input, and, everyone. I mean, these are major organizational issues that have to be addressed in good times and bad. I mean, we dealt with a technology company recently, and for them, it was, you can put money into marketing or you can put money into improving the product. And which of those is going to have a quicker ROI, and which is going to have a more impactful ROI, and which lasts longer. And, at the end of the day, it's a compromise, and cash flow is one of the things that we have to take into account.
So what I think what the subject that Vito brings up really highlights that in a recession or in any troubled times, the better your leadership, the better you're going to do. Whether it's the CEO, the board of directors, or the CFO making decisions, sometimes it isn't the obvious place where you stop spending money. The better you are at knowing where to put your resources, the better you'll survive.
Right.
Yeah, I want to, it's a question later on. I'll just move it up now. One of the things, leadership is so important during a recession, is to communicate to employees. And if you have to take actions, you kind of, it's like pulling off the Band-Aid. You do it quick and you do it fast. And then you say, we've taken these actions to weather the recession, and then that's it. We're going to continue on with that. The worst thing people don't want to know in a recession is tomorrow, you laid off 10 people today. Are you going to lay off 10 more next month, and am I in that group? And then you get nervous people, then productivity goes down and they start looking for a job. So leadership, you have to communicate what are the steps we're going to do to handle the recession, and how does it affect the employee? If you tell people that, we're going to have to cut your pay, you're going to do a furlough, tell them, and then that's it. Don't keep dribbling out moves that people are always looking over their shoulder. This next shoe going to drop. What's going to happen next? Because people are nervous during a recession. You want to try to say your job's secure. We've taken whatever measures, and we're going to move from here.
Switching gears just a little bit on the employee retention credit. Are you still seeing businesses apply for that? Are you seeing that as a meaningful source of capital for businesses? Just interested in any color you may be seeing there.
I mean, I know businesses are still applying for it. If you could, if you can qualify for it. I know there are a lot of people out there saying that everybody should get it, I mean, I hear there's a lot of people that are applying that are getting it that don't qualify. Problem is, you may hear back from the government a year or two later and say, we gave you the money, but I know that happened with an employee during the pandemic. I have some friends whose kids applied, got the pandemic insurance, and now the state came back after them and said, you really didn't qualify this, you got to pay it back. So you got to be careful when you apply for some of these programs. You may get it, but then your government may try to claw back on it. So if you legitimately qualify for it, actually, and get it, you should do that. But be wary of some people who are saying you qualify when you don't.
It'd be especially problematic if they charge you current interest rates.
Yeah.
All right, let's see if we can hit a couple more before we run out of time. Okay. Next one is for Jay. What factors do lenders consider when evaluating loan applications, and how can businesses present themselves in the best possible light? What are the risks and benefits of borrowing money during a recession, and how can businesses mitigate those risks? How do banks view credit differently during a recession? So we've touched on some of this, but
yeah,
I think there are aspects to add as well.
Absolutely. Look, seasoning is important. Have you made it through recessions before? How have you adjusted with COVID? When you're applying for a line of credit or any type of loan at a bank, they assess key management capabilities. We'll ask that question, sometimes even going as far as to ask if there's a succession plan. Even if you're in your 40s, is there a key employee that you need to have that's, on board that could take over, right? These are the things that are part of that process. So it's not something that you think about all the time. You think about cash flow, you think about the typical dynamic metrics, the last 3 years of return, the profit and loss, the balance sheet, AR aging, all those things. Those are typical. But I think one of the things that just, is more important during this time is that seasoning component. How long have you owned the business? How has that been going? Where are you in the life cycle of a business? And so I'll talk about risks associated with it. Look, the risk is there. You could, let's say, take out a line of credit, use the money, and then let's say it doesn't pan out in terms of what you're using the money for. Your good or service is not quite as demand as you thought it would be. So now you owe the bank some money at a higher interest rate, right? Look, higher interest rate is just going to cost more. It is what it is. But the benefit really is that, if you do have that extra cash on hand to be able to utilize that's not out of your operational cash, you can deploy that money in a way that could really just lift you to the next level. If you know that what you're supplying is of value and that demand is there, that's a great time to get it. Look, we always say that the best time to get a line of credit is when you don't need it, because when you need it, you're not going to be able to get it. So I always tell people, if things are going well, that's great. Let's get you a line of credit so that if things do turn around at some point, you have this cushion for you as well. It's one of the easiest ways to leverage your bank, is to do that. Look, the other thing too is that knowing that during recessions, banks are looking for more reasons to say no. Just that's also part of the supply and demand of it. It can be harder to get an approval. Look, we're talking about cash flow before. We're cash flow lenders. Most banks with the cheapest money are cash flow lenders. You can get banks out there that aren't necessarily, they may charge more or they're not as financially sound, So you want to get to a bank that is a cash flow lender. They look at EBITDA, they compare that to the loan payback amount, basically to make sure that every dollar we lend you, you have $1.25, right? It's a 1.25x debt service coverage ratio, essentially. It's a typical bank. Those are the most healthy of banks, when you get that number. One of the issues also that I've noticed with clients coming to us is that clients don't like to pay taxes. So they bring down the net profit so that they don't have as much income to tax, right? Of course, the problem is that we can't lend based on that, right? If that number is going to distributions or it's going to, less of a bottom line in terms of net income on the tax return, that's our gospel, essentially. The tax return is the probably the most important thing in certain industries, financial statements, reviewed and so on. But ultimately, you want to think about that as well. You want to think about your business long term. Yes, you want to pay yourself. Obviously, we're in this business to make money, 100%. But if you want to make more money longer term, the key is to make sure that your business shows profit. The more profit you make, the more money we can potentially lend to you. So this is just a couple of highlights of things that, during a recession that you need to look at. But I would say the number one thing is the seasoning in regards to what we look at as far as lending to a small business.
Can I have a follow-up question to that, Gershon?
Yeah,
sure.
Howard, that's a good question. And Jay, I want to ask you to think about this for a second.
Sure.
Much of the decision making, you elucidated a lot of points that you look at when you're going to lend money, but how much of your decision making is curtailed or modified by regulation? In other words, in your opinion, in your experience, I'm sure you run across guys you'd be willing to lend to, but regulators say you can't because it doesn't check all the boxes.
I don't think regulation comes into play when it comes to that quite as much. There's business decisions that banks make. So I've had the experience of working at least 2 business banks for the last 10 years. Citibank had a different credit profile than Valley does, just to give an idea. So there were deals that I couldn't do at Citi that I can do at Valley. And that's just a business decision that they've made. So yes, regulation comes into play with regards to, let's say, how much money we put aside towards things. But like, for example, cannabis. Cannabis is a business that Valley will lend to. Whereas at Citi, they won't even open accounts for them. And they'll exit you from the bank if you have clients that are cannabis related, right? So we made a business decision to do that. We created state chartered banks in New York and New Jersey to be able to handle that. Now, we haven't done a lot of loans. We've done probably 4 loans this whole time since we've been in this business. So it's hard to do it. But that's because the actual, sphere of cannabis right now is mainly startups. And so it's rare where you get a very large company that has the experience, the seasoning, like we talked about, the cash flow, to be able to lend to. So that's just a sort of a product of the actual space, the industry. But I think what you're describing, regulations don't necessarily touch what banks decide to lend to. It's the bank itself makes a business decision whether or not that's a space that they want to lend to.
Also, you didn't mention the value of personal collateral. I mean, we're not talking about a lot of big businesses, a lot of small businesses, but I don't even think you mentioned collateral at all, as a matter of fact. But to the extent that you can get personal guarantees, I presume you look for them.
Yeah, so personal guarantees right now are like sort of, a handshake, basically saying, yes, I stand behind my business. I'm not going to, take all the money out and go to Jamaica. So it's a basic at this point. And for most banks that are cash flow lenders, PGs are important and it's a basic. Look, unless it's an SBA loan, we're not going to look to take a lien on any of those assets. Only if, let's say, the business goes under, then at that point, we might have to go after you personally. But generally speaking, the SBA is the only 7A loan in particular, asks for a lien on the house or, let's say, marketable securities, things like that. And they generally look for that in SBA. But yes, personal guarantee is important. I think the biggest thing that over the last 2 weeks in particular has changed is that banks are going to ask for the deposits. So let's say we want to do a loan. We're going to also say to you, we need at least 10% of the loan in a deposit somewhere at this bank, or we've been requesting the full relationship. Other banks, like, for example, at Citi, won't do the loan itself unless you have at least X amount of dollars in the account. So these are things that banks are going to be tougher on and require more of. We don't require the personal accounts to be with us. We want at least the business account. And we understand that it takes time to migrate over to a new bank, that kind of thing. But banks generally, especially with what's been happening the last couple of weeks, will ask for the full relationship. And you want to be with a bank that asks for that full relationship. You hopefully will be able to get that level of service as well back from that banker.
One other thing, can I give you some required reading?
Sure.
Ogden Nash agrees with you that bankers will be glad to lend you money as long as you don't need it.
Yeah. Yep.
Read his poem. Bankers are just like everybody else except richer.
Oh, okay.
You'll enjoy it.
All right. We are going to wind this down because we are almost at 12 o'clock. Thank you all for joining. I'm going to put the poll up now. Any final questions, jump in. And
it looks like Brian has a question.
All right, jump in.
So
everyone
he's
else
asking,
the poll up.
Yeah, if banks ever pull their lines of credit. The answer is yes, banks do pull their lines of credit. Now, it's rare when that happens. A couple of times that I've seen that it has happened are industry-based. So, for example, if a bank decides to get out of a business, they can potentially say, hey, look, we're going to term your loan. Basically, we're going to give you a term to pay it back. It could be 12, 24, 36 months. And you're going to be exited at least on the line of credit side. That does happen. Citibank does that a lot, but it's business decisions basically. So let's say they find a flaw in an industry. They could say to you and call you, and or maybe they won't even call you. Right? Larger banks don't necessarily even do that. They just term you out. You want to be able to, let's say, go to another bank and show that you can maintain that debt service essentially, and be able to get a loan there. Many times they'll do it because your type of business isn't doing well in this economy, and that could happen. So you want to make sure you have a good relationship with your banker so that open line of communication is there. If you don't have a person, see if you can get a person, small businesses especially, because you're the CEO, you're the president, you're the CFO, having that open line of communication to that banker is going to be crucial. Hopefully that answers your question.
It's a good one, but Brian, I want to advise you that because you're so young, there's more than good reasons to terminate a loan. I've experienced political reasons why a bank pulled out, and it's wise to have as many banks as you can in your credit line. And because it was political, I was able to get it refinanced easy enough with other banks.
Yeah.
But sometimes it's just somebody's angry at somebody.
Many times it's miscommunication. Yeah. I've been able to smooth over some things in my banking career that's where somebody was, I just think of a specific example. When I was at Citi, we had a client that hired somebody as their CFO who left. So they hired them in like 2001. They left in 2003. That individual who was the former CFO of that company went to move on to somewhere else and got fired because of fraud. Nothing to do with the company that we lent to, but because that company now then sort of somebody must have Google searched somewhere and said that they had worked at this company, the line of credit was shut down. So they got in touch with me. I was able to communicate with our back office and able to keep that line open, essentially save that relationship.
Yep.
All right. Thank you to our amazing speakers.
We have to stop.
We can do another one if people want. Anyone who wants another follow-up one on this, let me know. We can schedule another one. So I want to thank our speakers, and I also want to thank Andrew when you win the prize for the most questions and interaction. So thank you very much for all of your excellent questions. Thank you, Brian, and thank you, everyone else.
Thank you. Have a good day, everyone.
Have a good day.
Thank you. Have a great day.
Take care.